Ladies and gentlemen, good day and welcome to SALZERELEC Limited Q4 and FY26 earnings conference call. As a reminder, all participants' line will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I now hand over the conference to Mr. Salzer from Aditya Birla Capital. Over to you, sir.
Thank you. Thank you, Akash. Good evening, everyone. On behalf of Aditya Birla Money, I welcome you all to the Q4 and FY26 post-earning conference call of SALZERELEC Limited. This conference call may contain forward-looking statements which are based on the beliefs, opinion and expectations of the company as of the date of this call. These statements are not a guarantee of the future performance and involve risk uncertainties that are difficult to predict. I now invite Ms. Savli Mangle for the opening remarks to be followed by the question and answer session. Over to you, ma'am.
Thank you, Ankit. Good evening, everyone, and thank you for joining us today to discuss the audited financial performance for the fourth quarter and year ended March 31st, 2026. I have with me Mr. Rajesh Doraiswamy, Joint Managing Director, Mr. K. Raman, Chief Financial Officer, Mr. Bellari, AVP Business Development, Mrs. R. Menika, General Manager Accounts, Mr. K. M. Murugesh, Company Secretary, and Mr. Jitendra Bakaria, Non-Executive Director, KC Industries. Starting with the consolidated financials for the quarter and year ended March 31st, 2026. During the quarter, our revenues increased 26% year-on-year to rupees 474 crores from rupees 376 crores in the previous corresponding period. This growth was mainly driven by higher demand for industrial switchgear, wires and cables, and building product division, mainly on account of high demand products like three-phase transformers, wire harnesses, relays, and new products like contactors, etc. The contribution from exports stood at 15.6%. EBITDA, excluding other income, was rupees 31 crores in Q4, as against rupees 29 crores in the corresponding previous period, a year-on-year growth of 7%. The EBITDA margin for the quarter stood at 7%. Profit after tax was rupees 10 crores in Q4. Coming to the full year performance. In the year ended March 31st, 2026, our net revenues in FY26 was rupees 1,758 crores as against rupees 1,418 crores in FY25, a year-on-year growth of 24%. This growth has been largely driven by higher demand for industrial switchgear, wires and cables, building products, also on account of high demand products like three-phase transformers, wire harnesses, relays, and new products like contactors. Contribution from exports stood at 21%, largely driven by higher sales from Europe. The EBITDA, excluding other income, stood at 147 crores in FY26, as against 134 crores in FY25, a year-on-year growth of 10%. The EBITDA margin was 8%. Profit after tax was 54 crores, as against 52 crores in the previous corresponding period, a year-on-year growth of 3%. Coming to the revenue breakup as per the businesses, starting with the industrial switchgear business. This contributed to 56% of the revenues in full year and 51% in the quarter. This business grew 15% year-on-year in Q4 and 20% year-on-year in FY26. The EBITDA margin for this business in Q4 was 8% and for the full year was 11%. Coming to wires and cables, this business contributed to about 43% of our revenues in the quarter and 39% in FY26. There's been a 42% increase, year-on-year increase in this division during the quarter and 30% in the full year. EBITDA margin for Q4 stood at 4% and 5% for the full year for this business. Coming to the last one, which is building products division. This contributes 6% to our revenues in the quarter and 5% in FY26. This translates to a 36% year-on-year in Q4 and 16% in the full year. In the full year, FY26. Export front, for the quarter and the full year, the export share was nearly 16% in Q4 and 21% for the full year. I would now like to hand it over to Rajesh to take us through the business developments and the way ahead. Thank you.
Thank you very much, Savli. Good evening, everyone, and a very warm welcome to Salzer Electronics earnings conference call for the fourth quarter and the year ended March 31st, 2026. Thank you all for taking time to join us today. We have shared our results update presentation and the media release. I hope you all must have received and gone through the same. Some key highlights I will share in some recent developments and also the outlook for the future before we open the floor for question and answers. FY26 has been another very important year for Salzer Electronics as we continue to strengthen our position across industrial switchgears, wire and cable, building electricals, and emerging businesses such as EV charging, smart metering, and energy management systems. Despite a very volatile global environment, elevated commodity prices, and pricing pressure in certain categories, we delivered healthy revenue growth during the year, supported by strong demand from industrial capex, infrastructure development, power distribution upgrades, renewable energy investments, and export markets. Our industrial switchgear and wire and cable business continue to remain the growth drivers for the company. India's electrical equipment industry continues to witness very strong momentum backed by rising investments in transmission distribution infrastructure, manufacturing expansion under the China Plus One strategy, railway modernization, renewable energy capacity additions, data centers, and urban infrastructure development. The Indian electrical equipment market is expected to maintain a double-digit growth over the coming 4 to 5 years, mainly supported by rapid electrification and industrial automation, expansion in renewable energy and strong infrastructure like data centers, increased adoption of EV charging ecosystem, government focus on energy efficiency and localization, and of course smart meter rollout under the RDSS scheme. Now coming to our key updates and the recent developments, we are pleased to announce a strategic partnership with Wirepass, a global leader in wireless mesh connectivity solutions, headquartered in Finland. Through this collaboration, Salzer will integrate Wirepass certified platform into Salzer smart electricity meters, enabling the deployment of next-generation metering solutions designed to help utilities operate more efficiently and intelligently. Coming to our new growth businesses, in smart metering, we continue to build strong capabilities for the long term. We now have installed a fully integrated EMS facility in-house for manufacturing and assembling electronic PCB boards for the smart meters. While execution timelines in smart metering industry have been relatively slow than initially expected, we have already executed a business worth approximately 45 crore over the last year. And we remain highly optimistic about the long-term opportunity in this segment. As of now, we have not secured any large long-term orders, though we continue to be in discussion with all the potential customers. Under the energy management solution business, a 200 crore project in Bangalore Corporation is currently under execution, and we expect the revenue contributions from this project to start flowing in from Q2 of this financial year at a steady monthly run rate. In EV charging solutions, our subsidiary, Ultra Fast Chargers Limited, continued to make progress during the year. We have already sold around 100 chargers, generating a revenue of approximately rupees 9 crore. With increasing EV adoption and potential strategic tie-ups with larger ecosystem players, we believe this business has significant growth potential as we move forward. We currently hold orders for close to 100 DC fast chargers from various customers. On the export front, exports currently contribute around 24% of the revenue. During the year, we faced certain temporary challenges due to geopolitical tensions in the Middle East, which impacted progress related to our Saudi Arabia operations and also created volatility in oil and petrochemical prices globally. However, we continue to remain positive on our international business prospects. Our UK operations continue to benefit from favorable currency movements and also the zero import duty advantage, which strengthen our competitiveness in the market. Operationally, the global situation, increased oil prices have impacted to a large extent on our margins due to the increase in the prices of all petrochemical-linked plastics, supply chain disruptions, increased freight cost, and continued increase in commodity prices. At Salzer, we source a lot of plastics for all our products, and this impacted our margins to an extent of 2 to 3%. In Q3, talking about last quarter, we faced increase in prices of silver and copper, which we had offset to some extent by way of price increase in February 2026. However, now the plastic price increase impact of Q4 will be offset only in June 2026 by way of another price increase to the market. At the same time, we are also happy to say that the market has accepted the price increase from us very, very smoothly. Our subsidiary, KC Industries, continues to perform well. KC's top line grew 9% year-on-year in Q4 FY26 to rupees 17 crores from rupees 15 crore in Q4 FY25 and 13% year-on-year in FY26 to rupees 60 crore from rupees 53 crore in FY25. EBITDA was at rupees 2 crore and PAT was at rupees 1 crore in Q4 FY26. For the full year FY26, EBITDA was at rupees 8 crore and PAT was at rupees 5 crore. Looking ahead to FY27 and beyond, we remain optimistic about the opportunities ahead. The long-term growth drivers for the electrical equipment industry remain very strong. India's focus on infrastructure, energy transition, manufacturing localization, industrial automation, smart grid, and electrification continue to create a very large addressable market for all our products and solutions. Going forward, our strategic focus will remain centered on expanding our high-margin industrial switchgear portfolio, scaling up our smart metering operations, and strengthening our export and international business. With strong manufacturing capabilities, diverse product offerings, and increased presence in future-oriented business, we believe Salzer Electronics is well positioned for sustainable long-term growth. Before I conclude, I want to thank the entire Salzer team for their dedication and hard work. I also thank all our stakeholders, our customers, for their support. This is all from our side now. We can now open the floor for questions.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on your touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and one again. Participants are requested to use the handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Disha Bordia from Sapphire Capital. Please go ahead, ma'am.
Hello. Am I audible, sir?
Hello. Yes, madam. Good evening.
Yes. Thank you so much, sir, for this opportunity. Couple of questions, sir. Firstly, on our EBITDA guidance of 10% for FY27, how confident, sir, are we of reaching this number? Because the last price hike that was taken was in February and March. We've seen April also had a fair bit of volatility. So how protected are we, and are we planning any further price increase?
Actually, a couple of quarters before we had guided that we will definitely reach 9.5-10% EBITDA margin, but unfortunately, I think there were a lot of situations that arose which was not under our control. So we had to undergo the pricing pressure because of the commodity price increase in Q3 and in Q4, new situation that came up because of the Middle East war with the plastic price increase. So these both have impacted, as I said in my speech, close to 2 to 3% of the margins because of the price rise. Though we have done a very good pass on of close to 15% price increase in Feb 2026, but the actual impact will be seen only in Q1. And in Q1, again, I think now we are facing pricing pressure on the plastics. So we are going in for another price increase in June 2026. So I expect that, margins will stabilize in Q2 of FY27.
Any sort of numbers on what sort of price? Yeah, in the June, how much?
In June, we will be doing a price increase of close to between 7 and 10% for different products.
Okay, and then so Q1 we might see a bit pressure, then Q2 will stabilize.
Yes.
So on an overall basis, we can, for the entire FY27, we're confident enough to reach 10%.
9.5% is what we expect for this year.
Okay, and how should one look at the growth, sir, and the contribution from the smart meter segment for FY27?
Our existing businesses growth, we expect we will reach a top line of around 2,000 to 2,100 crores. That's what we are looking at. On the smart meter, I think I'm not giving any commitment right now because we are working with a couple of large AMISPs customers, and as soon as we have an indication from them, then we will come back to you and inform you what's the prospects of smart meters.
And in terms of exports, so we want to go back to that 25% sort of revenue mix for FY27. What will be the key markets that will be targeting, and how are you looking at the overall export growth for this year?
I think our largest export market is North and South America, number one, and number two is Europe. I think these two markets contribute close to half of our exports. We will continue to focus on these two markets apart from the Middle East business. Unfortunately, this year on year, I think our exports have degrown by around 5%, mainly due to the tariff issues from the US, which has dropped around 6% from last year, and also the Middle East crisis, which has reduced our business close to around 10 to 12% compared to last year.
Okay, and so this energy, the EV charging business that we have, what sort of margins do we see here?
Actually, EV charging business, we are doing it with our subsidiary, Ultra Fast Chargers. Right now, I think we are continuing to do break-even business because of low volumes. Once the volume picks up, we expect that the EBITDA margins on these products will be between 12 and 15%.
Okay. That is it, sir, from my side. Thank you.
Thank you.
Thank you, ma'am. The next question comes from the line of Mr. Kaushik, an individual investor. Please go, sir.
Hello. Hi, sir.
Hello, sir. Good evening.
Sir, I just want to ask, I have two questions. First question is, what is the mix of B2B and B2C in wires and cables business?
Our majority of our wire and cable, whatever business that we are showing, I think this year our contribution was around 40% full year. All the 40% is B2B. Our B2C business, including the wires and cables, including all other products, comes under the building segment business, which is around 5% of our revenue.
And sir, is L&T our largest customer? Client concentration? What is the client concentration?
Our single client concentration is Schneider Electric, which will be close to around 12% of our total revenue.
And L&T and all will be down below 10%.
L&T is now a part of Schneider.
Oh.
And okay. Whatever business we were doing with L&T is the business that we are doing with Schneider, but that is not a single client concentration because that's distributed widely in the market by Schneider. So we don't consider that business as a single client business.
And sir, I have a query. See, I'm looking your wires and cables business, and in last con call, someone asked what is the borrowing you are currently been using for wires and cables. You told them that you are using like 50%. I did some calculation. So out of 500 crore borrowings, I think around 250 crore we are using for wires and cables business, which is like steady state. You will be making around 6.5% EBITDA margin. And if I calculate the interest and everything, I think it will only make 1.5% PAT. Am I right, or am I missing something?
No, you're right. Actually, we will be making close to 2.5% PAT. The debt may not be 50% exactly, because it's very dynamic. Because as the other businesses grows, the debt usage for other businesses also increases. Today, I think close to 60% of our revenue comes from industrial switchgear business. So the debt usage also might be a little higher with the switchgear business.
And sir, but your 40% business is like wires and cables is contributing only 10 to 15% of the PAT. So is there any possibility to demerge both businesses? Because switchgear business is a high margin business, and it has a lot of growth potential. Because we are not a net cash company. We are using like 250 crore debt only to generate some 1.5-2% PAT on a steady basis. You leave alone the FY26. So is there any possibility to demerge and create some value for the stakeholders? Because
we will look at the options. We take your suggestion. It's a good input. Definitely, I think others have also given
because debt is so much, sir. Because 500-250 crore we are taking debt, and bank even for bank itself you are paying 20-22 crore of interest for wires and cables, and generating only 7-10 crore PAT. That doesn't help shareholders, sir. So kindly take this suggestion.
That will definitely take your suggestion in a positive. We'll see what we can do on that.
Because I'm following some other companies like RR Cable and everything. Many companies they have actually lean balance sheet and higher margins. So the entire EBITDA is mostly flowing to the PAT, that is creating value. But here we are not a debt-free company. So taking debt from a bank and then deploying to a 5 to 6% EBITDA margin, it actually is not helping shareholders, sir. So that is the reason we are still at a 1100 crore market cap. Else we would have the funds which are being flown to the power and energy sector is huge in Indian market, and I think we need to do something to unlock the shareholders' value.
Suggestion taken, sir.
Thank you so much, sir. Bye.
Thank you, sir. The next question comes from the line of Mr. Bhagat N. from Prosperity Wealth Management Private Limited. Please go ahead.
Hello. Thank you for the opportunity. What are your expectations for the business outlook regarding smart meter tenders? As a local manufacturer, do you have an advantage for Tamil Nadu smart meter opportunity?
I think things are still evolving, so I don't think there's any update on that front as of now, but I'm sure that the earlier tender will be cancelled and the new tender will be floated for the smart meters. That's what we expect. So we will have some clarity on this as we move forward the next 1 or 2 months.
Okay. But as a local manufacturer, do you have the advantage over other manufacturers, particularly for Tamil Nadu?
There's always a class that gives some advantage for some percentage of business for local manufacturers. Okay.
Thank you for the answer. And my second question is, in our switchgear segment, could you please provide the approximate percentage breakup of the cost of our key raw materials, say plastic, silver, and copper?
Will be difficult to provide that information here in the call, as it might lead to some competitive information that I will not be able to disclose. Okay. But overall, on the switchgears, our gross margins stand at around 40%, 35 to 40%.
Okay, and the EBITDA margin is expected to improve in switchgear segment going ahead?
Yes, I think EBITDA margin we were trying to get to around 13-14%, but unfortunately the situations beyond our control actually has continued to pull that down. We were at around 12% in Q3, which dropped to around 8% now. Overall, I think next quarter, Q2 onwards, it might stabilize between 12 and 13%.
Okay, understood. And as you mentioned regarding Q1 also could be a little bit subdued with regards to margin. And is it we can expect the same margin as compared to Q4, or is going to be lower than that?
No, it can be better than Q4, but it may not be as expected.
Okay. Thank you so much for your answer.
Yeah.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. I repeat, if you have any questions, please press star and 1 on your telephone keypad. The next question comes from the line of Mr. Ankit Kapoor, an individual investor. Please go ahead, sir.
Hello. Sir,
Good evening, sir.
Good evening, sir. Sir, my question is actually other previous participant has raised. So in other previous calls also I raised this issue regarding debt. The debt or short-term borrowing especially, CC FY26 short-term borrowing stand at 503 crore now. So it's continuously deteriorating shareholders' value, and net profit margin is just 3.1% this time. So when can we expect this to normalize to up to 5% at least?
Sir, your point is right. I think we will consciously see that our working capital debt doesn't go beyond 25% of our total revenue. I think that's how we have been managing for a long time. Unfortunately, I think this year, like some time back during the COVID time and the previous financial crisis, global financial crisis times, we have exceeded that and we have touched around 30%. This year, I think there is a combination of events. I think one, because of the geopolitical tensions and the commodity price rise, our margins have dropped by close to around 2%. That is one. Second, I think the working capital and the capex debt that we have invested on the smart meter and the smart meter business not scaling up as expected has also impacted. So we expect all these things to get smoothened out in FY27, and you will see our overall debt levels coming back to 25 or below percentage for the overall revenue.
And sir, our trade receivables, they are continuously rising. So any reason for that?
Sir, as the business volume grows, I think trade receivables will continue to increase, but we will have to see what are our receivable days. I think we continue to maintain between 90 and 95 days of receivables. Even if you take we have to consider our gross revenues when we look at the trade receivables. In that case, I think we are well below 90 days, which is reasonable for our industry.
Okay, and sir, the last question is, as the previous participant has said, that please convey our message to the management to unlock the shareholders' value by demerging or do something, anything like bonus share or something like that. That's also
definitely. I think that's also one of our main objectives is to definitely increase the shareholder value and market cap. So we will continue to work on that, and we will take in the suggestion positively. We will work on it.
Thank you.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on the telephone keypad. I repeat, if you have any questions, please press star and 1 on your telephone keypad. The next question comes from the line of Mr. Balamurali Krishna from Oman Investment Advisors. Please go ahead, sir.
Hi, good evening.
Good evening, sir. Go ahead, sir. Hello.
Balamurali Krishna's line is disconnected. He's not in the line, sir.
Okay.
Line got disconnected. Ladies and gentlemen, if you have any questions, please press star and one on your telephone keypad. We have one more question from Mr. Kaustubh, an individual investor. Please go ahead.
Hey, hi. So I just wanted to know why is the EBITDA margin for the wires and cable business so low? Like there are other companies and they're almost double of the EBITDA margin that like we have. Like if we are at 4-5%, they're around 8-9-ish%. So any reasons for that?
So I agree with you. I think almost 70% of our business is B2B. I think that's one reason that our margins are lower. Secondly, if you see, I think we were also at around 6.5-7% a year ago, a couple of years ago. Just dropped now. I think the main reason is because of the increase in the commodity price. I think we used to make a certain absolute amount.
Press 1 for Chennai Bridge.
On a copper price of say 700. Today we make an absolute amount on a copper price of 1400. So as a percentage, I think it is dropping. But if you look at the absolute number, I think we have been growing as an absolute number.
And then the business is not really generating any profit, right? If we factor the interest expense for that.
Given I think in the previous question's answer, I said we are making 2% to 3% of PAT.
Okay. One last question. So you told that this year you will be exiting at 9.5% EBITDA margin. So is it like an exit number, or are you mentioning that for the whole year aggregate you will have 9.5% of EBITDA margin?
For FY27 guidance is what we are trying to achieve, 9 to 9.5%. Yeah.
Is it 9 or 9.5? Sorry.
Between 9 and 9.5.
Okay. Sure.
Thank you, sir. The next question comes from the line of Mr. Balamurali Krishna from Oman Investment. Please go ahead, sir.
Hi, sir. Sorry, my line got dropped. So I have seen some positive comment from AMSCs. So they are expecting some good ramp up in the smart meter installation. So how confident you are to get some good chunk of business in this financial year, and you are already in discussion with some AMSCs. What would be the approximate quantum you are looking for this financials?
So the addressable market for smart meters is still close to around, I would say, 17 crore meters. We are talking to AMSPs and we are addressing with these AMSPs requirement close to around 2 to 3 crore meters. So we have to see what percentage of share of business we will get out of the discussion that we are doing with them. We are confident. I think we will scale up this business, and hopefully by this year we will have some very good news coming in on this business front.
Okay, sir. Secondly, on this 22 crores thing to have inventory FG stock of the smart meter, which is waiting for dispatch clearance. So whether it is dispatched or it's still under FG?
No. Whatever we have done last year, we have done. I think up to Q3 we have not done any business on that. With small invoices we are doing, but nothing significant.
And on the electric EV fast charger, sir, so you told that we have 100 DC charges order, which would be around approximately 10 crores of revenue. So earlier our anticipation is to have 100 DC charges per month. So how do you see this will be shaping up in the FY27? What kind of revenue we can expect the entire year?
The entire year, I think we expect close to around 25 crores of revenue. That's what our expectation as of now. But as we move forward, if things work out well, we'll update you, and we can revise our estimate as we move forward in after Q1 or Q2.
Okay, sir. That's all now. Thank you.
Thank you so much. Ladies and gentlemen, if you have any questions, please press star and 1 on the telephone keypad. I repeat, if you have any questions, please press star and 1 on the telephone keypad. The next question comes from Mr. Rohit Kodi from Progressive Shares. Please go ahead, sir.
Hi, team. A couple of questions from my side. The first one being on this Saudi expansion. Sir, if you can take us through what is the exact business model for Saudi operations?
Hi, Rohit. Good evening. Regarding Saudi, I think the main reason that we wanted to get into there for manufacturing is because of the local government's insistence of Saudi-made products to be used in the upcoming projects in Saudi. One. Second, I think Saudi also has been growing at a very fast pace because of the large investments that they have been making in various infrastructure projects. So we saw a lot of business opportunities coming up there if we be a local Saudi company, and that is the reason that we went in there. But unfortunately, as we started to implement the project, I think the Middle East war came up in February and then pushed our plans, delayed our plans by close to around now 6 months. So we started the process now. I think we have ordered for the capital equipment, machineries and things, tools and dies. So hopefully by August this year, we will receive all those equipment, start installing, and start operations from September, October this year.
Okay, sir. While we probably might look at making Saudi as a export or maybe manufacturing hub for GCC and the MENA region, what sort of investments do you think that you will have to put in now? Because the earlier one must have been escalated, right? The price or the capex that you must have been thought of. So what is the current capex that you will require now?
We are not seeing any capex escalation because of the delay. We might see some minor additional OPEX that we will be spending because of this delay. Otherwise, there's no capex escalation. We still continue to see, I think we will be investing close to around 15 crores in phase 1 to set up and start the operations.
And in these investments, maybe by FY 28-29, what sort of revenues do you anticipate from these developments?
Currently, the Middle East and Africa business, we do an export business of around 24 crores. That's the revenue that we generate out of this region by exporting from here. So we think that this can double over the next year, FY 27-28.
Because this also can provide an impetus to the exports, which we are generally talking about 25% of the revenue should come from the export division. So you think that you've been conservative with this number of 50-odd crores from the Saudi plant?
I think Saudi plant, the first year we are a little conservative, okay. But overall we are expecting that this Saudi plant has to generate 100 crores of revenue catering to the GCC countries.
And these will be very much in line with the wires and cable business, or you're going to be targeting only the switchgears?
Right now we are starting with switchgears.
Okay.
As we move forward, once the project is set up, then if there is a demand and there is a operational feasibility, then we will start wires and cables there.
Another development, sir, was with the synergies that we tend to see with Efiloom and Aura Wind. If you can just take us through that, what synergies do they bring to the core business?
Efiloom is an SPV that we promoted to implement the Bangalore Corporation street lighting automation project.
Okay.
So that's been a business that we have been doing for several years, since 2010 until 2020. Then we actually didn't take up any project post that. But this was again another good opportunity that came up, and then we have taken that project. So that's an SPV specifically for that implementation of that project. So I mentioned that the revenues from that project will start flowing in from July, August of this financial year.
And anything on
second? Arowin, that's again another SPV that we have formed with one of the market participants in the smart metering business. We're trying to create this platform so that we can use this as a bidding company for upcoming future tenders, if any, for the smart meters. We're just getting ready so that, because the smart meter tendering requires a lot of technical qualifications, financial qualifications to be fulfilled. So we are making this company as a bidding company in future with all the required qualifications.
And lastly, sir, if we look at a LinkedIn page of Salzer Group or maybe the company as a, we see that there are quite a lot of products that have been posted over there related to HVAC or maybe custom-built panels or ACDB or DCDB, which have some combining effects and the solar. So we can just take us through these new developments. Are these absolutely new products or are they some sort of catalog products which we have been already working on? On the R&D and product development, I think it's a constant process that we continue to, vertically develop a lot of products within our existing product range. So all these products are new developments, but not completely new. It's a existing product, vertical new developments for some specific applications, like for HVAC, as you said, HVAC specific application products. Or so in AC/DC combo is a solar specific product from our circuit breaker range, and some of them from our contactor range. So those are the products that we continue to develop, seeing the market opportunities and cater to those applications. So do they come under the Salzer branding, or do we do some contract manufacturing for some customers?
Salzer branding, it's all our catalog products.
Okay. Sir, last question from my side. At what ROC threshold do you think that the management team would approve a new capex?
I think our target is around 18% ROC.
And that would be by?
That's what we want to achieve.
By which year? FY 28, 29?
Difficult question. I think we are working out to see how quickly we can reach that. But we want to see progress on this year on year. That's what we are expecting.
It's fair to assume by FY 30 you will be targeting 18-20% ROC?
Yeah.
Okay. Thank you for answering my question.
Thank you. Thank you.
Thank you so much, sir. The next question comes from the line of Mr. Shravan Modi from Syndicate Family Office. Please go ahead, sir.
Thank you. Hello. Good evening, management. Yeah. Couple of questions. First question would be, what is the proportion of expenses, raw material expenses, which is passed on to the customers? Right, like, from your end.
Sorry. Come again.
What percentage of raw material expenses which are increased is passed on to the customers at the end?
Ideally, we want to pass on 100% of the increase to the customer, but fortunately or unfortunately, I think we are unable to do so in one shot, and also at the speed at which the input increases. I think this time the inputs increase also was not very constant. They've been increasing on a weekly basis, fortnightly basis. So we also were not sure what is the extent that the input is going to increase. So that's why we had to wait until February 2026, and I think the entire market did that. All our competitors did that. We did an increase in 2026, and now we are trying to do it in June again. So I think in these two increases, we will be passing on 100% of our cost escalation to the customer.
Right, sir. Also, could tell me about how competitive is the organization globally in terms of pricing and certifications in terms of product quality as well, in terms of how competitive globally they are?
I think in most of the products that we are in the top three in terms of quality, in terms of pricing. We also command a premium for certain products because we are number one in the market. And the capabilities that we have is something that many of our competitors don't have, and that's also one of the reasons that our OEMs stick with us.
This is those who are going to join the queue. Thank you so much.
Sorry, I think you're not clear, sir.
Saying that what is the competitive moat of the organization in terms of globally well placed, where they could say that the company is really, we can differentiate among the peers?
Our moat is that we are the only company in this segment manufacturing this basket of products catering to our OEMs. I don't think there's any close competition that we have in this segment, except for the foreign competition. We have foreign competition, we have Chinese competition, we have companies from other countries who are competing with us.
Right, so thank you so much for it. I'll join with you for the question. Thank you.
Thank you, sir. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. We have a follow-up question from Mr. Kaushik, an individual investor. Please go ahead, sir.
Hi, sir.
Hello?
Can you hear me? Can you hear me, sir?
Yes. Yes, sir. Good evening. Tell me.
What is the revenue mix you are expecting for FY27 between wires and cables and switchgear? Will it be the same percentage mix, or there will be any change?
Mostly it will continue to be 55, 40, and 6%.
Okay. Sir, another question is regarding the smart meter. So whatever order we have delivered for smart meters, are there any receivables left, or we have received all the payments for what we have delivered?
We have received all as per the contract, whatever that we have received, except some 3 or 4% that will be held until 8 years.
Do we have any orders or inventory currently lying?
We are expecting some orders. That's what I said. I think there's no guidance that I'm giving as of now until we are very clear and confident from our customer side.
So are we holding inventory as on date, or?
Yes, we are holding inventory.
Okay. And sir, what is the interest and the depreciation which you are expecting for FY27 for a normal business, which you are telling like 2,000 crore top line and 2,100? Will it be the same interest cost and depreciation like this year, or there will be more comparatively because of the higher working capital requirements?
Definitely there will be higher working capital requirements. I think there will be an increase of at least 10% in the interest cost, in my opinion, but that's what we expect. Depreciation should remain the same.
What is the average interest cost we are paying to the banks for the short-term borrowing?
8% approximately.
Okay, sir. Thank you. That's all.
Thank you so much, sir. As there are no further questions from the participants, I now hand over the conference over to Mr. Rajesh Doraiswamy, Joint Managing Director, Salzer Electronics Limited, for closing comments.
Once again, I think thank you everyone for your interest and time taken to come and attend this call and show interest in the company. Looking forward to our interaction in the next quarter. Thank you very much.
Thank you, sir. On behalf of Aditya Birla Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.